Gold has always been a symbol of wealth and prosperity. From ancient civilizations to modern times, people have always been fascinated by gold. But is gold really the golden investment that it's made out to be? And why do we, as people, love gold so much? Today, I'm going to explain why gold is actually a terrible investment and why I don't hold any of my own money in it at all. But I don't expect you to just take my word for it. So in this video, we're going to explore the facts and the hard evidence and give you a balanced, data-driven view. And I will be fair, so stick around until the end, and I'll also explain the rare occasions where it can make sense to invest in gold. If you're new to the channel, I'm Adam. I'm a chartered financial planner. And this channel is here to help you simplify the world of personal finance and investing. So if you're trying to get on top of your finances and you want to make better money decisions, then hit subscribe to catch more bite-sized videos that will help you do exactly that. Now let's get into it. So why do people love gold so much? Well, firstly, it's tangible, so you can touch it, see it, feel it, you can hold it in your hands. Unlike with stocks or bonds, which are typically just a number on a screen, gold feels real. And therefore, people have an easier time psychologically connecting with it. Secondly, gold has a long historical association with wealth. Think about any time period in history, from the Incas to the Egyptians. Kings, queens, emperors all wore and hoarded gold. It feels prestigious, and this has been ingrained in the human psyche over thousands and thousands of years. So even though it might not be sensible or logical in the modern world, evolution is slow, and so undoing that level of psychological conditioning takes a long time. So it's definitely still hanging around up there somewhere and probably will still be for a few more generations yet. And finally, gold is just very pretty. That's probably its main use these days. We wear it all the time as earrings, necklaces, watches, and all sorts of other jewelry. And unfortunately, this muddies the lens through which people view gold. It's very hard to love Apple shares or the aggregate value of the stock market, but gold is easy to love, and therefore it's easy to assume it's a good investment. But here's the catch. Just because gold looks good around your neck or on your ring finger doesn't make it a good investment. In fact, gold is actually more speculating than it is investing. So let's talk about why. Investing, by definition, means putting your money into assets that will produce an income that will help to grow your wealth over time. Think about stocks, bonds, or real estate. Stocks are basically companies, and they very clearly produce revenues and profits, and then pay those profits out to you as an investor in the form of dividends. Real estate produces a rental income, and bonds produce interest income. Gold, on the other hand, doesn't produce anything. It just sits there, relying on the hope that someday someone will eventually come along and pay more for it. And in economics, there is an actual name for this. It's called greater fool theory, where investment gains aren't produced by productive investment returns, but by finding a greater fool who's willing to pay a higher price than you did for the exact same thing. As Warren Buffett said about gold, it won't do anything except look at you. To put this in perspective, if you bought 1 ounce of gold in the year 2000, today, you'd still have 1 ounce of gold. Whereas if you'd bought Apple shares instead, you'd have owned a share in a company with around 8,500 employees generating just under $8 billion in annual revenue. If you fast forward to today, you'd now own a share in a company with approximately 160,000 employees generating around $383 billion in annual revenue. Now, I don't know about you, but I know which one I'd rather own as an investment. The key word here is productivity. Companies are productive. They generate an income and actually create wealth. And that's exactly what you're trying to harness as an investor. A common argument in favor of gold is that it has stored value for thousands of years, and it's been an excellent hedge against inflation. But has it really? Let's dissect that a little and look at the data. Over long periods of time, the store of value argument definitely holds true. Here's the data for the last 100 years, which is the longest data set I could find quickly and easily. And yes, gold has been a store of value and has protected your money from inflation. But global stock markets have been a much better store of value and have done a much better job of protecting your money from inflation. Okay, so maybe gold is an okay, but not a great hedge against long-term inflation. But what happens when people zoom in and start talking about hedging against specific short-term shocks or specific periods of inflation. And over shorter term periods where this hedging characteristic would be useful, the picture is completely different. For example, look at the price of gold from 2020 through to the end of 2023, when we had COVID, supply chain issues, oil spikes, rising inflation, and a cost of living crisis, all in very quick succession. How do you think gold hedged against all of that? As it happens, not very well. Gold prices were incredibly unreliable, bouncing around erratically between $1,700 and around $2,400. Gold has only really started to perform well again since late 2023, almost perfectly aligning with when inflation began to decline. So that's the complete opposite of an inflation hedge. Ultimately, the only true protection from these short-term chaotic periods is to stay laser focused on your long-term goals, remain patient and disciplined, and weather the storm. So to sum this up, over shorter periods of time, gold is probably going to let you down if you're relying on it to hedge your way out of periods of economic turmoil. And over longer periods of time, there are simply far better ways to beat inflation. Next, there's this idea that gold is a safe haven asset. And this is something that I'm quite happy to call out as pure nonsense. In simple terms, the thinking is as follows. If the world collapses and society is reduced to a primitive state, then gold will be your ticket to survival. But let's think about that for a second. Firstly, think about what the world would actually look like in this scenario. In a true crisis where money becomes worthless, what's going to be more valuable? Gold or essential items like food, water, and medicine? In this post-apocalyptic wasteland scenario, which is probably not something you should be wasting time worrying about anyway, gold's utility is severely limited. You can't eat gold, you can't defend yourself with gold, and you can't stave off infection with gold. So in a real emergency, gold is far from being a practical asset. If you were genuinely planning for this kind of scenario, then you would be far better off using your money to move to a rural area, build a bunker under your house, and stockpile tin food and ammunition, not buy jewelry and shiny pieces of metal. And secondly, the vast majority of people don't even invest in physical gold, which completely undermines this point anyway. It's usually an investment product that tracks the price of gold, like this one from BlackRock. Not many people think about this, but for investment products like this one, you can actually check the latest vault inspection and see where the actual gold is. For this one, BlackRock keep the physical gold in a secure vault in a branch of JP Morgan in central London. And all I can say is good luck fighting your way through a zombie-infested city of London to retrieve that gold, especially if you've prepared for that day by investing all your money in gold instead of guns. Bringing things back to a more serious note, I did promise to keep things balanced and give you the full picture. So now that you understand why you shouldn't invest in gold, let's talk about when it can make sense. While it might not be an attractive investment, and perhaps shouldn't even be considered an investment at all, gold does provide some diversification benefits. So a small allocation to gold can improve the risk-return profile of your portfolio. In a recent study by Rebecca Asset Management and the Lancaster University Management School, they studied the impact of adding gold to a standard stock bond portfolio. I am going to get a little bit technical here, so bear with me. I will keep it digestible for this video and just breeze through the highlights, but if you are more technically minded and you do want to look through the detail, then I'll leave a link to this paper in the description for you. This table, which I've taken from the paper, shows the impact of adding gold to a 50-50 stock bond portfolio using data from 1975 through to 2022. To explain what you're looking at, we start with the 50-50 stock bond portfolio on the left, and then add gold at 5% increments until the portfolio is 50% gold by the last column on the right. By now, you know that gold is not a good investment, so it should come as no surprise to see that the annual return falls consistently as you add more gold to the portfolio. So, if you only care about maximizing your returns, then there is no evidence to suggest that gold should be included in your portfolio at all. However, what is interesting is the diversification benefit. So if you care not only about maximizing your total return, but also about improving the risk return profile of your portfolio, then there is some evidence to suggest that a small gold allocation can be useful. In the world of investing, there's something called the Sortino ratio. Now, it sounds technical, but it's actually quite simple. The Sortino ratio measures the risk-adjusted return of a portfolio, meaning it tells you how much return you're getting for the level of risk that you're taking. The higher the Sortino ratio, the better your return relative to the level of risk. And as you can see from this data, a small allocation of 5 to 10% in gold does actually improve the risk-adjusted return of the portfolio, raising the Sortino ratio from 1.56 to 1.61. However, beyond the 10% allocation, the benefits start to diminish. So the risk-adjusted returns begin to fall, and the portfolio performance worsens as you add more gold. So when does it make sense to invest in gold? Well, the answer to that is that it can make sense to invest a small amount in gold, say 5 to 10% of your total portfolio, if you're looking to increase diversification or reduce overall risk in your portfolio. But the data suggests that going beyond that threshold is likely to hurt your portfolio, leading to higher risk and lower returns. So what's the bottom line? Well, while gold might look and feel like a good investment, it doesn't hold up under any close scrutiny. It's speculative, it's not a reliable inflation hedge, and it's definitely not a practical safe haven. There are simply far better places to put your money if you want to build wealth and secure your financial future, which is why I don't hold any of my own money in gold. If there's one key takeaway from this video, it's that you should rethink the way you view gold. Instead of seeing it as a core investment, consider it a diversifier. And whether your portfolio needs another diversifier is entirely up to you. Thanks so much for watching. If you enjoyed this video talking about where your money probably shouldn't be, then you might also enjoy this video where I talk about passive investing and where your money probably should be. If you have any questions, drop them in the comments. And otherwise, don't forget to subscribe for more bite-sized videos that will help you to improve your finances. See you soon.